Welcome back. It's my pleasure to remind you that every single Tuesday morning for the past 25 years at 8:05, the melodious voice of Chuck Malamut graces these airways. And it's just a privilege to do this program with Chuck. The following program is presented by Chuck Malamut, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck, do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley, Smith Barney, member SIPC. Mr. Malamut, good morning, sir.
Good morning, Harry.
I know we're going to have a better show than I have in picking football games.
Full disclosure. So now you have.
You mean 4 wins isn't good?
No, so you have Brother Bill.
Out of 16 games?
Now Brother Larry has jumped on the bandwagon to remind you, Harry, that he was the number one Malamut brother with the highest number of correct picks this past week, and I think that you desperately need a change of scenery. I think this is what this is all about.
I need my trip, right? I need my trip to Disney.
You need to get re-energized and refocused, and I know when you come back, you're going to put this incredible push on.
Yes.
And as and nothing better than when you start, you have to continue to dig yourself out, and it's such a great feeling at the end when you pass everybody.
Well, remember, I am a long-distance runner by trade. This is not a sprint. I'm a long-distance runner, and it's not how you start, it's how you finish.
And I think that's what we posted in the beginning of the year. This is not a sprint. This is a marathon. So it's okay, Harry. It's not a big deal.
Thank you. I'm feeling good.
At least you're doing well with your day job.
Yes, and I thought that my own disclosure of that would be better than what could happen to me if I waited for it to come up. Not from you. But, there are always people willing to take shots at the king.
You have a lot of people, Harry, that would like to take a shot at you. There's no doubt about it.
So, Chuck, what is the market update? How are we doing?
Well, Harry, it's certainly been interesting over the last several weeks, and I can remember August the 24th and looking at the monitors and just literally saying this is one of those surreal moments, and it was, and I think that if you remember the flash crash that we had,
yep.
And then the multiple events, prior to that, and all sorts of articles and books were written as a result of what happened. The fat finger story as well. But I'm thinking that there's more to this than what we saw actually. We saw the event. And I'm not totally convinced that the explanation that we've received to date, is 100% satisfactory. I think there's something that might have happened that we are not aware of, and it might very well surface, sometime, in the not too distant future. Now, unfortunately, that creates a fair amount of anxiety for not only retail investors but institutional investors as well, because when you look at your capital. Basically, if you're long, versus being short, and you watch your capital, erode very, very quickly. It's basically how do you get out of the way of a runaway freight train, and those sorts of moments that really test your fortitude, and then you say to yourself, "What did I buy? Why did I buy it? And if I bought it at 100 and it's now at 75."
Yep.
I really should go in and buy more. But unfortunately, investor psychology, and we've all, we have all become, involved with investor psychology and being on the wrong side. And it's just the most amazing thing, Harry. You wait for sales at retail stores or on the internet, mm-hmm. and you say, "Wow, what a great bargain! I just bought something 25, 30, 35% off." And now all of a sudden in our world, it's just the opposite. It's like, oh my goodness, if I bought the position at 100, I'm certainly not going to buy it at 65. And then it begins to sink in, and then the psychology is, well, I'm going to get out when I get even. And that's just certainly such a waste of intellectual capital and assets, because there might be other opportunities, instead of writing something down, because not everything works.
Well, I'll do one of your questions that you usually pose. How many people out there realize that since the end of August, which is the period that Chuck brought up just a little bit ago, he mentioned a specific date, but it was at the end of August. The end of August to now, the Dow Jones Industrial Average is actually 5% higher than where it stood at the end of August. Who would believe that?
Well, Harry, I think that absolutely no one would believe it, and
because it doesn't seem like it, but it is absolutely true.
I think if you polled the average retail investor, and you said to them, "How are you doing this year?" chances are they would come back and say, "Oh, it's been awful, and I lost a lot of money." And in reality, when you take a look at the major indices, the S&P is up 2.5% year to date, but a lot of that was put in just last week. I mean, if you take a look at last week, the S&P amongst the three indices was actually the worst performer. Believe it or not, Harry, the NASDAQ was up 3.4%. The Dow Jones was up 2.5%, and the S&P was up slightly over 2%. So you're sort of at that, at that top range now at 2,075 on the S&P, and who would ever believe that the S&P was in the 1800s just 2 months ago?
Are you a believer? I'm not asking you to subscribe to it, but just generally speaking, are you a believer in what's called the Halloween indicator? I did a study of the past 15 years, and like never before, this Halloween indicator that some call it, or the sell in May and go away, that the months, this is real positive that I'm coming to. And by the way, it's no guarantee whatsoever in terms of what the future will bring in terms of performance. But for basically the last 15 years, what seems to happen, Chuck, is that from Halloween for 6 months later is usually a very strong period.
Harry, I'd like to be a believer of that. Unfortunately, it's like the Santa Claus rally.
Yeah.
You have these certain periods of time where they're named after particular events. The problem with the Halloween effect is the fact think about it for a minute. We started at middle. Well, actually, it was the end of August. The market retested itself in September, and then as has been on an upward, a very, very upward positive bias ever since then. So a lot of the gains have been put in already. So I want to believe in the Halloween effect, but I think that it might be a little telling as to where we're going. I mean, there's a lot on our plates right now. I think the best news is what has happened is even though we're all ramping up for the debate tomorrow night in Colorado. We had one just recently in Las Vegas, and all eyes are on that on those spectacles, I guess is the best way to call it.
APM, University of Colorado Boulder.
Right, but I think what is happening here is that putting that aside for a second, not a lot has come out of Washington, and that's actually good news. There's not been a lot of noise.
What if they get this budget deal that would basically be the equivalent of like collective bargaining labor peace for the next 2 years that actually would go into the next presidency? Would the markets like that?
I think the markets would like that. I think the markets certainly like stability.
And raising the debt ceiling limit? Part of it.
It is part of it. I mean, as individuals, I'm sure we're all not happy about that, right? Because it's just you have this, this budget that goes on forever, and you have deep pockets that are filled with your money that our government has a tendency to not only spend but to overspend.
So, how are we doing corporate earnings wise?
Well, Harry, here's what's happening. As we chatted about last week, corporate earnings for the most part are beating expectations. But we might, at the end, when it's all said and done, might actually post another quarterly decline. And what does all that mean? So 1/3 of the S&P 500 companies going into today have reported third quarter results. 77% of those companies have beat estimates by an average of about 5%. But if you look at earnings, they are on track right now to post their first back-to-back declining quarters since 2009. Remember 2009, where we were in the economy. Reported earnings may be down around 2 to 3%. You take out energy, well, you can't take it out, but if you take it out, we would be up roughly, 4 to 5%. So, and I think this is what troubles the Fed. You think about...
And why they can't raise interest rates and why they won't again.
Well, they exactly. I mean, again, there's about a 30% probability that there will be a movement in December. The majority of the economists that have been polled seem to believe that move will probably happen in the first quarter of 2016.
And yet at the beginning of the year, we almost for sure believed that at some point during 2015, there would be a modest rate hike increase.
Yeah, and Harry, I think that when you take a look at what the Fed is faced with, I mean, you have economic events not only here domestically, but you also have international exposures as well, because we are obviously a global economy, and what we're seeing, and to kind of flip back to earnings for a second, is a lot of the multinationals, because of this. I mean, we all kind of pound the table and say, "Hey, this is great that our dollar is so strong. We are the strongest currency. Everybody measures up to the U.S. dollar, et cetera, et cetera." But the problem is that a lot of multinationals have taken anywhere from a 10 to 15% hit in earnings just as a result of the escalation of the U.S. dollar versus these foreign currencies.
Is there a serious push? You and I have talked about this on several occasions over the past year to 2 years, actually. What's the Chinese currency called? Is it called I've heard it called the yuan.
Right, yuan.
Yeah, I've heard it called yuan. I've heard it called yuan. So whatever you said, the yuan. Is there a serious move afoot for that to become the big dog and not the dollar?
No, I don't think so. I mean,
I don't think so either, but some people do.
As evidence as to what happened, with respect to their equity markets, the fact that it went up like a rocket ship and it came down, unfortunately very, very quickly. And now year to date, I mean, that market, Harry's up just under 5%. I think the way their government reacted to that declining market is clearly an indication that they are not prepared, to become, the number one country at this point. I mean, think about it. Here was a country for forever that was communism, socialism, and you can't flip the coin and go from socialism to democracy overnight. It just doesn't happen.
I don't think they are doing that anyhow.
Well, they're not. But they claim to be.
Yeah.
So
sure.
So the problem is that
you can have the internet for 4 minutes today, highly tightly restricted access,
and you can have one child, and that's it. But I mean, there's obviously, as someone said to me the other day, the Chinese are great at copying, at cloning. We might produce something here in the U.S., and they have the ability to reduce those costs by 50%, but they don't create anything.
No.
So that's so to answer your question, I don't think their currency becomes the number one currency.
Good. I don't think so either. He's Chuck Malamut. I am Hurley in the Morning. We'll be back in just a few minutes. Flyers, Buffalo Sabres tonight. Here are the details. 24 minutes past the hour, we're visiting with Chuck Malamut, our official financial advisor for the Hurley in the Morning program for the past 25 years. You can reach Chuck, who is the managing director. He leads his team, the Malamut Group, at Morgan Stanley's Northfield office for all of your financial planning needs. That's everything. That's sitting down with Chuck and putting together all your hopes, your dreams, your goals, college building, vacation building, retirement, all of it. Turn to Chuck. Tell him I sent you. 609-383-2010, 609-383-2010, and you'll find out all about Chuck's perfected concept of total asset management with the all-important asset allocation factored in. Chuck, we talked about the market update. We talked about corporate earnings. How are things from the consumer standpoint? That's kind of important.
Well, Harry, the consumer is obviously very, very important in this process because Christmas is how many days away?
I should know exactly, but it's very soon. And I'm hearing, Chuck, that we're expected to see an uptick in Christmas spending. You know,
Harry, the reports to date have been mixed with respect to what's going to happen with Christmas. And as one of the things that we chat about, the consumer is part of that, all too famous three-legged stool. And, the consumer, for the most part, from what we can see right now, the consumer remains relatively strong and should and has to be an important driver of U.S. economic growth.
Doesn't the consumer, though, objectively speaking, remain, I don't know if skeptical is the right word, but just a little bit unsure in terms?
Yeah, I mean, Harry, but the consumer, you would have thought by now with the decrease in the price of the pump, that tax break, the consumer would be out spending, both fists full of cash, ready to go. But what is happening,
they're exercising restraint.
Yeah,
correct?
I mean, we do expect as we get, as we kind of tally up the third quarter, that retail sales would have increased by roughly 3 to 4%, and that's coming from a couple areas: auto sales, restaurant, buildings, building and materials. As you build a home or you renovate a home, and obviously everything is happening, over the internet. What has happened, we've had, gains in the labor market. I know that you'll disagree with that as we chat about every so often. You've had personal income has increased to a certain degree. Family incomes are starting to move up ever so slightly. So that in itself should support the consumer as we get into, the fourth quarter, and then we get into 2016. So the consumer, and I've seen multiple reports with respect to Christmas spending, and it's been all over the map, where some analysts are saying it's going to be just, a very, very trying time just to get back to where we were last year. And there's some analysts that are expecting, growth to be anywhere from, say, 3 to 5%. So only time will tell. But, again, this is something that the Fed is looking at to make that determination when, in fact, they're going to make a move with rates. Because they're going to have, I think all of us are sitting here waiting to say, okay, when you're going to make that first step.
Do you think the Fed could just shock everybody? I mean, I know you said it's a 30% chance, so it's not exactly a terrible long shot. It's still greater odds that it will not happen. But might the Fed just at some point just do it, just suck it up and just do it? Because every time they're close to pulling the trigger, some either geopolitical event, as you would call them, happens, or a jobs report comes out that isn't right. There just seems to always be the brakes get put on right before they're ready to do it.
I think, Harry, the markets would not. I think the markets would probably react in the wrong way if the Fed caught everybody by surprise. As we mentioned before, we're probably talking early 2016. Pending any that all the numbers line up. But remember, the Fed is not just Janet Yellen. I mean, you have a board of governors, and there has been a number of split decisions for the last several meetings. Where some
so,
of the
in other
Fed,
words, I've always thought that the chairman, whether it was Volcker, whether it was Greenspan, Bernanke, now Yellen, I thought the chairperson I'm not saying that they're a dictator, but doesn't their will sort of drive the bus?
Well, it's yeah. I mean, it's like any committee, Harry, in any jurisdiction. And
like if the chairman said we're going to raise interest rates by 25 basis points, wouldn't the committee go along with it?
I'm not so sure about that.
Okay,
I think
that's important information.
You read the meeting minutes, and there are times where you have a number of dissenting votes in one direction or another. So it has the decision not to make a move has not been a unanimous decision for the last several meetings for sure.
We're at 30 minutes past the hour. I know Chuck is going to talk about ECB, China. ECB, is that the European Central Bank? Is that what we're talking about?
It is, Harry, yes.
And a little bit more maybe about the Fed as we continue. One more power segment straight ahead with the official financial advisor to the Hurley in the Morning program in our 25th year together here on WPG Talk Radio 1450, South Jersey's talk station. For all of your financial planning needs, turn to Chuck Malamut. He is the managing director, the leader of the Malamut Group at Morgan Stanley's Northfield office, 609-383-2010. The official financial advisor to Hurley in the Morning, Chuck Malamut. Hey, thanks very much. Welcome back. 35 minutes past the hour. Chuck Malamut, yours truly, Hurley in the Morning. So let's go to ECB. What's happening?
Harry, if you take a look at last week, I mean, the rally stemmed, from two particular reasons. One, the ECB went out with, and announced some additional easing, and then in China there was another interest rate cut, and those two events, created that upward bias within the equity market. So, there might be some additional easing coming out of the ECB in the not too distant future. They took a very, very dovish tone at the last meeting that they had last week with the policy meeting, and that provided a very, very strong upward bias for risk assets, as we refer to them. So the central bank during that meeting indicated that it saw some downside risks to the economic growth and potentially in inflation, and as a result, suggested that it may expand its QE program that we went through here in the U.S. When they get to their next meeting in December. The market obviously liked that, and if you look at domestic versus international, a lot of the economists and analysts that follow the market seem to believe that there is a very, very good opportunity outside the U.S. and particularly in Europe, moving forward. Then when you look at China, they cut their rates again, 25 basis points in their what they call their 1-year lending and deposit rates, and that's been the sixth cut that we have seen over the last year in China, and they're doing that in an effort to stimulate their economy. So those two events, and the fact, as we chat about volatility, it seems as if the market is now, for the most part, while we still are in a trading range, for this year, mid 1800s to 2000 or so, 2100 in the S&P. It seems as if the volatility has subsided somewhat, and investors obviously, are pretty pleased with that.
Chuck, one of your listeners, big fan of you and your show, asked me to ask you about when you hear me say asset allocation. Why is asset allocation important?
Well, Harry, perfect case in point, if you were invested in 100% equities and 100% international equities, countries that are domiciled in the Far East, as a for instance, you would have had a very, very challenging time as we approach the end of August. Now, we will never, ever make that recommendation to any client or prospective client. But what happens is, with proper asset allocation and being able to set your goals, and that's where the whole process started. I was just thinking about, in the beginning of the show, what you were telling your listeners what we do and how we do it. That plan is very, very important because, Harry, I'll take you back to a baseball analogy here. When you are batting, are you going to try to hit a home run every time you come to the plate? Probably not. It'd be more a situational play where, and actually, you'll see it tonight as you have two very, very different teams playing. But what'll happen is that it's situational, and the same thing happens in our world. Maybe you don't need to hit a home run. You need to just need to hit singles and doubles, and occasionally try to hit the long ball. And again, within asset allocation, and if you have set your goals and truly understand where you want to be 10, 15, 20 years, and believe it or not, Harry, as we do our retirement planning modules with our clients and prospective clients, the average age mortality right now, the average female lives to like 92, 93.
Chuck, when I started to see that with you and your program and some of the things we do with your brother and with Joe McDermott, I was just shocked when we start talking averages, because that, to me, if you think about it, Chuck, when you first started out, the difference between what you would need for a lifetime then and what you need for a lifetime now, it's a whole different ballgame. So as that continues to change, are we still talking about basically three general categories, Chuck? Cash, stocks, bonds?
I mean, there is alternative investments in there as well.
Yeah.
As we refer to them, whether it's a hedge funds, private equities. But the one thing about AI or that space, you have to be very, very careful. You have to make certain you have liquidity, and you need to understand what you own and why you own it. But I mean, traditionally speaking, equities, fixed income, and cash. That's those. You can round it out if you have personal real estate, but obviously. For the most part, unless you have positive net flow on a rental income, we kind of put that to the side because you have to live someplace. And and in our planning module, maybe the dream is, because I know that we've talked about this on multiple times and how expensive it is here to stay in New Jersey and die in New Jersey.
That's why so many people are leaving.
Yeah, maybe you sell your house, you have net positive. You have. You paid your mortgage off or most of your mortgage, so you have a one-time event of liquidity, which could potentially get into your investment portfolio. So we take all those events, not only in the asset side but the liability side. Even taking care of, an aging parent, for instance. We put all that into the plan. So once you have the plan and you understand what your spending is, and we take your spending and increase it for inflation. We obviously, don't know the implications of potential tax reform, because what a great time of year. I mean, every ad that you hear is,
Sure.
and the campaigns down here are just ugly.
Ooh.
I mean, I'm waiting for them to end, and I'm sure that the candidates.
You may have had NPR during that part of the early morning today, so you may not have heard my incredible analysis of, did you know, this is a Rutgers Eagleton Institute poll. 75% of New Jerseyans do not even know that 1 week from today is election day.
I believe it. Yeah.
Only 6% of those that were respondents knew that their 2 assembly seats are up. Only 5% of those that were part of the survey knew the name of their state senator.
Ugh.
There's 9 million New Jerseyans. There's 40 state senators. You only have one. And 94% of the people could not name their state senator. And we wonder what's going on. It's pretty wild. So also, Chuck, asset allocation matters in terms of if you are sitting down with Chuck at age 30, or if you're sitting with Chuck or an existing client for, say, 30 years, the difference between being 30 or being 60 or so, asset allocation matters in terms of where you are in this stage of your life.
Oh, absolutely. And it's all, we constantly talk about this, with our clients and prospective clients, because the end result is putting the money to work effectively. The challenge is to understand what the allocation is and how risky or does the prospective client want to be. In an upward market, I mean, risk on, everybody loves equities. There's no doubt about it. Like, the problem is on the flip side, when you have the events that we had in August, then all of a sudden you clearly understand, a client's risk tolerance, and we remind our clients of those discussions, to make certain that they stay on the proper track.
Closing comment, Chuck?
Well, Harry, I mean, look, we have just seen, as you mentioned before, about the positive momentum that we've had in the equity markets since August, and the market recovery is pretty surprising. When you look at it, because the overall economic backdrop hasn't really changed over the last few months. There's obviously concerns that we know about with growth in China, and as a result of that, we've had falling commodity prices, which helped precipitate the rout that we had back in August. Europe looks to be outside the U.S. looks to be in a developed world, so to speak. Looks to be a pretty good place to be at this point in time. So you might want to have your listeners take a serious look at what they own. The Chinese economy is clearly slowing. We understand that, and we think it's probably going to be decelerating to that 5% growth. And I think you'd be real happy with 5% growth here in the U.S.
Sure.
So if you think about it, what drove the equity rally over the last couple of weeks? It's been stabilization, volatility has subsided. You've had some positive policy action in China. Again, the easing that we talked about with the ECB, the delay that the Fed hasn't made their move yet. A lack of what we call the negative noise coming from Washington. It's been so quiet, and that's actually been very, very good. Credit levels at banks, for the most part, are increasing. They're pretty healthy. And we've had a lot of the merger and acquisitions. You see these announcements. It got quiet for a while, but last week, you've had a couple pretty big deals hitting. So I think that as we get into the fourth quarter, as we get to the end of the year, I think you're going to probably see an upward bias. But let me, Harry, please, your listeners clearly need to understand there's something we're working on right now. Capital gain distributions from mutual funds. This is going to be a very challenging year because what is happening is that funds are obligated to pay out all their gains, regardless of performance. And what we're seeing are some funds that are going to be paying out capital gains that represent anywhere from 10 to 15 to 20% of the net asset value of that asset. So think about it. You made no money to speak of, maybe 3, 5, 7%.
But you have a taxable
event. But you got a taxable event. So if you haven't, you really need to take a look at what you own and make sure you plan, because you don't. The worst thing that can happen is, that call on April the 15th, I just came back from my accountant and I got to write a huge check and nobody told me. So your listeners that have retail accounts, not IRAs, need to clearly understand this, and they have time to adjust before the end of the year.
Important advice with just barely more than 2 months left in 2015. Chuck, thank you.
You're welcome, Harry. We'll see you next week. Again next week, hopefully.
And then the following week, you'll be flying with Captain Kirk.
Correct.
Chuck, I'll see you next week. Look forward to it. You've been listening to Chuck Malamut, who presents this program each and every week. This program presented by Chuck, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck, do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley, Smith Barney, member SIPC. Until next week, Chuck.
Harry, thanks for having me. Better luck on your weekend activities.
Yeah, I really can't do much worse.
Well, you can, but that's okay.
Then that means I didn't do too bad then. If I can still do much
there's always room for improvement
Yes.
for all of us, including myself.
All right, my man. We'll be back in just a few minutes. Remember, for all of your financial planning needs, turn to Chuck Malamut, 609-383-2010.